Hello, everyone. Welcome to our first session of Yes FinPulse, our brand new webinar series dedicated to exploring the technical aspects and broader discussion in finance. Imagine a world where financial decisions are not intimidating but empowering. That's precisely our mission at Yes Securities to make finance accessible to everyone, regardless of background or experience. At Yes Securities, we don't just facilitate transactions, we enable transformation. Over the past decade, we have evolved from transactional broker to a trusted advisor for both retail and institutional clients. Now, let's get down to business. Our burning question for today: can you achieve trend prediction insight in and under R? And answer is, my friends, big yes. And who better to guide us through this topic than our esteemed guest, Mr. Nitin Bagde? Before we dive into today's topic, let's take a quick moment to reflect on our last session. Last month, we had a privilege of hosting first part of our trained following with moving averages webinar. I hope you all found that session as enlightening as I did. Please join me in extending a warm welcome to Nitin Bagre, an industry expert with an impressive 25 years of experience in technical analysis. Nitin's expertise spans across commodities, equities, and derivatives, making him master of predictive and reactionary analysis. Today, he'll be discussing the second part or more advanced version of trend following with moving averages. And guess what? If you miss on any of our session or want to revisit the valuable insights shared, don't worry. We'll be uploading the entire series to YouTube under a playlist named Yes Finpulse so that you can catch up at your convenience. Remember, this isn't one-way street. We want to hear from you. After Nitin's presentation, don't hesitate to ask questions and share your doubts in comment section. Your engagement is what makes this series truly special. Over to you, Nitin.
Thank you very much. Good evening to everybody. In last session, we have done uh, trend following with moving averages part one, but thereafter I received few queries and few new people have also joined this session. So, in first 5 minutes, I'll just run through the last presentation, and thereafter we will go forward. I hope this will help the new participants.
Hello, everyone. Welcome to our first session of our brand new webinar series dedicated to exploring the technical aspects and broader discussion in finance.
Very sorry for a small interruption, a small technical glitch. Anyway, so as I was saying, since there are new participants also, so I'll be running through the previous presentation in first 5 minutes, and whatever queries I have uh, got thereafter, I'll try to answer that also. So let's start. So what is trend? Trend is nothing but a shape, the shape of prices on the chart. The uh, the the prices on the chart represent the mass psychology. All the traders, investor, arbitrators, everybody's who makes the prices, discovers the prices, and those prices when charted gives us the psychology, mass psychology of market participants. And and uh, Charles Dow was the first person who described a trend in these prices. So, why does this trend occur? It is basically a herd mentality due to which the prices trend. So, what is basically a trend? It is a shape, and it makes prices makes higher high, higher low, higher high, higher low. This is a series of higher highs and higher lows which are made on chart, and that is known as uptrend. When in reverse, when higher low lower highs and lower lows are made, it is downtrend. So basically, Charles Dow described trend in three ways. He said that the major trend or larger trend, he called it a primary trend. It can run for years, and there are few uh, contra trend movements. Those contra trend movements he called secondary trend. Secondary trend is also known as intermediate trend. So basically, prices moves up, corrects a bit, again moves up, corrects a bit, again moves up. In this way, they form higher highs and higher lows. The contra trend price movement is also known as correction. So secondary trend, intermediate trend, and correction all are the same name for a particular price movement. Thereafter, in a primary trend, there are few secondary trends. Secondary trends can be, or we'll call it intermediate trend. So intermediate uptrend, intermediate downtrend, intermediate uptrend, intermediate downtrend. This way, the primary trend progresses. The oscillation around intermediate uptrend and intermediate downtrend is known as minor trend. So minor trend will always move in the direction of intermediate trend, and it will keep on oscillating up and down above the line. Charles Dow warned that though the intermediate trend can be predicted, but the minor trend cannot be predicted. Markets will suddenly fall, suddenly rise in a day, in few hours. So those movements cannot be predicted. Those are the minor trends. And Charles also warned that one should not put efforts in trying to predict those minor trends, because trying to predict minor trend, sometimes you will be right, sometimes many times you will be wrong. The most of the profits come from riding the intermediate trend, especially in the direction of primary trend. If we try to ride the intermediate trend, which is in the direction of primary trend, then the most of the money is made. If we try to trade the minor trend, which is very uncertain, and most of the time people will lose money. So the money can be made by riding intermediate trades. The idea is when intermediate downtrend happens inside a primary uptrend, we try to play the we try to find out when we try to find out the bottom formation, and once we get confirmation that bottom has formed, then the intermediate uptrend will start, and in that way we can make the money in markets. The trends can continue for few months also. This is a chart of Aavas Financier, and in rectangle you can see the prices rising. They rose for few months, both the time. In between they fell, and again they rose. Now currently they are making lower highs and lower lows. That means the right hand side it is in downtrend. But trend does not, we cannot predict trend for how many months or how many years it can run. It will run till the time when the evidences start coming on the chart of trend change. Till that time, it will continue to rise or continue to run. So it can run from few months to many years also. This is Bajaj Finserv. You can see that from 2009 till 2020, the uptrend was moving up. The uptrend was continuing. Almost for 10 years, the uptrend was in force. So trend has not to be predicted, but has to be followed. We don't know when the next trend change will happen, but before happening, it will give us some evidences, and from those evidences, we will come to know when trend change is happening. One more point I want to add: trend change is always known after it happens. No one can predict beforehand. Our objective is to know the trend change from up to down or from down to up as fast as we can. The objective of technical analysis is to discover the trend change at the earliest so that we can write from the starting and till the end. Now, this is the monthly chart of Nifty trade, Nifty 50. You can see the green line moving, inclining upwards. This line tells us that primary trend is up. You can see the orange or red lines downward. Those are intermediate downtrends. Before, between the two intermediate downtrends, the price moved up, and that is intermediate uptrend. So intermediate uptrend, intermediate downtrend, intermediate uptrend, intermediate downtrend, intermediate uptrend, intermediate downtrend. This way, the prices are moving, and you will notice that none of the lows are visited again. Every time the low is higher than the previous. That means it is a uptrend. Even the 2020 fall, COVID fall, it didn't breach the 2016 bottom. So trend remained up, and it is still up. Intermediate downtrends or intermediate corrections may come, but the primary trend remains up. Now, inside the intermediate uptrend or intermediate downtrend, what are oscillation around the median line or the main up direction? What are oscillations that are happening in the direction of trend is known as minor trend. If you remember, Dow informed that one should not try to predict minor trends. Our main objective is to find a find an intermediate correction or intermediate downtrend inside a primary uptrend, and try to find out the bottom bottom will always be known after it happens. Nobody can uh, tell the bottom before it happens. So once the bottom happens, and on chart the confirmation comes that bottom has happened, then we can enter in the direction of trend. So trend is there on every time frame. On monthly, this is the primary trend, and the intermediate uptrend, intermediate downtrend becomes the primary trend on next lower time frame chart. If you see the 2020 bottom, that was a intermediate downtrend or correction. From that bottom, intermediate uptrend started. Again, one fall was there, that is intermediate downtrend. This intermediate downtrend will be seen as primary uptrend on lower time frame chart. So here again, primary uptrend chart, intermediate or secondary downtrend, intermediate uptrend, and inside those intermediate uptrend and intermediate downtrend, there are minor trends. Same way, we can go down to daily chart also. Now, here I must warn the listeners that the lower time frame we go, the chart becomes unstable. The chart movement will become fast. The primary trend, intermediate trend, minor trend will be on 5-minute chart also. But the chart will change from one form to another form, or one intermediate uptrend to intermediate downtrend so fast that trading that chart, enacting the understanding the chart, finding out the trend, finding out the bottom, and then taking a trade, one can manually cannot do it. Secondly, the lower time frame charts will remain unstable. Higher time frame charts will remain stable. The monthly chart, the primary trend on monthly chart will run for years. On this chart, you can see that the uptrend we started from 2003 is still continuing. Whereas on weekly chart, the primary uptrend started from 2020, and on daily time frame chart, it just started 2023 October. So the one needs a time as well as information as well as method to make a trade. If prices are moving so fast, then it becomes difficult to follow the process. Therefore, I'll suggest to trade in the direction of monthly chart or at least weekly chart. So direction of monthly or weekly chart will remain stable, and one can design the trade on lower time frame charts. So we will be using at least 3 time frame charts. So this is here I explained about the trend. Now where moving averages come into picture. So on this chart, this is a monthly chart of Nifty 50, and you will be seeing two upward slanting lines, one green and one orange. These green and orange lines are moving averages. What is moving averages? It is nothing but a summation of particular period, summation of prices of particular period divided by that period. It is an average. Why moving? Because every new time period added to the data is recalculated the last previous last one is deducted, and new data is added, and new moving average is calculated. Therefore, it is moving average. It moves with the prices. What does this moving average tell us? Now, basically, moving average, its slope tells us tells us about the trend of that particular security. In case of Nifty 50, on this monthly chart, you'll see that moving averages are sloping upward. That means the trend is up. The simplest form of moving average, explaining moving average is this only. The slope of moving average will tell one the trend of the security or a stock. These moving averages are 200 bars moving averages. That means 200 bars or 200 months, summation of 200 months divided by 200. So that will give you a value, and if you go on plotting this, you will get this type of upward slanting moving average. World over, the 200 moving average is used to know the primary trend. When used on monthly chart or any time frame chart, if the prices are above moving average, 200 bars moving average, then the primary trend is up. So whatever falls, whatever price, whenever the prices fall down, but do not cross below 200 moving average, that means those are corrections or pullbacks. There is a difference between pullback and correction. A pullback is a part of minor trend. Whenever minor trend always oscillate in the direction of uh, main trend. It will go up, come down, go up, come down. That is the oscillation. But it will generally move in the direction of main trend. So this coming down or a minor coming down is a pullback, whereas correction will be bigger one, and it will retrace much of the area of last rise. So how, and correction will be a part of intermediate trend. So intermediate trend and correction are same. Minor downtrend and pullback are same. Their degrees are different. The pullback will be smaller one, the correction will be larger one. Any correction, any pullback will not take out the bottom of previous uh, intermediate downtrend if trend has to remain up. Whenever last intermediate downtrend's bottom is taken out, that means the trend is changing, or the trend cannot be, trend becomes doubtful. So on monthly chart, this 200 moving average tells us that the primary trend is up. Now we need, basically the idea is during an uptrend to buy in correction, during the uptrend to buy in correction, during the downtrend to sell in correction, upward correction. So we must know, we must differentiate between pullback and correction. We must know that this is a correction and not a pullback, so that we can take an entry. Else, what can happen is that if a pullback is there and we assume it as a correction and we take an entry, a small up move will happen, and again after some time a bigger correction can happen. To save ourselves from this, we need to differentiate between pullbacks and corrections. As I told you earlier, that intermediate uptrend and intermediate downtrend are there. Intermediate uptrend, intermediate downtrend are a part of primary trend, whereas minor uptrend and minor downtrend are a part of intermediate trend. So minor moves or minor trend cause pullbacks, whereas intermediate downtrend cause corrections. How we will differentiate? We will use another moving average. 34 period moving average will give us a fair idea about correction and pullback. Whenever a small downside happens but does not crosses below 34 period moving average, that is a pullback. Whenever downward movement crosses below 34 days 34 period moving average but do not crosses below 200 period moving average, that is a correction. So once this differentiation is clear, we will not try to buy on small falls, small pullbacks. We'll hold our positions in small pullbacks. We can buy in corrections. If you see, 2004 uh, there was a fall, but that fall failed to cross below 34 period moving average. Whereas in 2009 or 2008, the fall crossed below 34 period moving average. So the 2004 was a pullback and 2008 was a correction. We if somebody is trading, somebody is taking decisions based on monthly chart, then he will not buy in pullback but and hold the earlier bought positions during pullback. But in correction, that is in 2008, he or she should have bought. So you'll see that many times the prices when comes down, they refuse to cross below 34 period moving average, and sometime they crosses below 34 period moving average but do not crosses below 200 period moving average. Even in 2020 fall, the fall was very severe, but it failed to cross below 200, whereas it crossed below 34. So it was a buying opportunity. This can be done on every time frame. This is on weekly time frame. Whenever the prices crosses below 34 moving average but fails to cross below 200 period moving average, then it is a correction. Else, any fall or any downside which fails to cross below 34 moving average, 34 period moving average, then it is a pullback. During pullback, we don't have to worry. A pullback on monthly chart can be a very serious thing for a person who is trading on or who is taking decision on daily chart. So one has to first decide what time frame one should trade. It depends on the availability of capital as well as the risk one wants to take. These two topics I'll be taking in future, in very near future. Today we'll be talking only about trend and where the entry can happen, how to enter, what are the problems while entering, how to solve those problems. Regarding this, I'll be talking today. So now I hope that the clarity about trend is there. This is a daily chart of Nifty. The last fall which happened during the month of March, On daily chart it is a correction, but on weekly chart it is just a pullback. So it depends what time frame one is playing or making decisions on which time frame. According to that, the pullbacks and corrections will differ. For a longer term, who one who invests for longer term, weekly or monthly charts will be better to take decision. One who trades for shorter term, the daily chart or 75 minutes chart will be a better one. The Again I'll repeat, the idea is to buy in correction. The idea is not to buy in pullback. It is to buy in correction. Corrections will always cross below 34 period moving average. Now, where is the opportunity to take trade? Now, the trend is clear. We have understood the primary trend, the intermediate trend, the minor trend. We have understood the idea also that one has to buy in correction. But how to spot that opportunity? So there are more than 10,000 stocks on BSE and more than 2,000 stocks on NSE. Also, the active stocks, I think almost 750 or 1,000 stocks on NSE are active. One cannot go and see each and every stock, chart of each and every stock, and decide the trend. That will be a very long driven process. Here also, the moving averages helps us. Whatever charting software one is using, there is a query model is there. One can run a query. So one has to run a query to find out those stocks which are above 200 days and below 34, above 200 period and below 34 period moving average. On running the query, you will get a list of stocks where the correction is happening. And then you have to go and only see those only stock on the charts. One does not require to see all the 2000 or 1000 charts. So this way we can save our time also, focus our energy also. This way the moving averages helps us a lot in defining the trend. Now, where is the opportunity to take a trade? So there are two scenarios. Just assume that there is a downtrend, primary downtrend, or a intermediate downtrend. Downtrend is happening, and it will turn into uptrend. So we should know at the earliest. So the we'll be using three different time frame charts. Higher time frame chart, generally I'll suggest to use as a monthly. Medium time frame chart, I'll suggest to use as a weekly, and smaller time frame chart will be a daily chart. The people who like to trade faster can shift it to weekly, daily, and 75-minute. Going below this, the charts will become unstable, the risk will increase. Sorry, the strike ratio will get affected. So the best combination is monthly, weekly, and daily. But one who wants to trade on lower time frame can use weekly, daily, and 75 minutes. So the conditions are, on monthly chart, I'll use the combination here, monthly, weekly, and daily. So the higher time frame chart is monthly chart. On that time frame, the prices should be above 200 EMA and SMA. And the second condition is the price should be above 34 EMA and SMA. That means the monthly trend is up. Monthly trend is strongly up. On medium time frame chart, that is weekly, the price should be above 200 EMA and SMA. The price should be below 34 EMA and SMA. That means on medium term chart or weekly chart, there should be a correction happening. And on smaller time frame chart, price, when we'll buy on smaller time frame chart, that is on daily chart, price should be above 34 EMA SMA, and the 34 EMA SMA should be about 200 EMA and SMA. I'll show you one example also. This is Apollo Hospital. You'll see that the left hand chart is monthly chart, the right hand chart is weekly chart. On monthly chart, you'll see that the prices for some time were below 34 period EMA and SMA. That means the correction was happening on monthly chart. That means the weekly chart were in intermediate downtrend. So on 30th November 2018, the first bar that crossed above 34 EMA and SMA. So from here, the trend change, the process of trend change starts after completion of November 2018. Same red rectangle I have drawn on weekly chart. If you remember what we wanted on the medium term time frame, the prices should be above 200 EMA and SMA. The price should be below 34 EMA and SMA. Now, if you see the left side of weekly chart where the rectangle just starts, this condition is not met. The 34 EMA is below 200 EMA and SMA. We need prices below 34 EMA SMA and prices above 200 EMA and SMA. That first time happens on 24/04/2020. From this point, this stock should have come on our dashboard. Once this 24th April 2020 happens, where the price was below 34 EMA SMA and above 200 EMA and SMA, then we should move to daily chart to time our trade. In this chart, the left hand chart is weekly chart. I have repeated the same chart, and on right hand side is the daily chart. Now you'll see that the condition for smaller time frame was that price should be above 34 EMA and SMA. The 34 EMA and SMA should be above 200 EMA and SMA. You'll see that most of the time on daily chart, 34 EMA was below 200 EMA. We require 34 EMA to be above 200 EMA and SMA, whereas prices should be above both the moving averages. That first time happens in a bar just previous to 5th of August. The 5th of August, 34 EMA SMA, 34 EMA SMA moves above the 200 EMA SMA. I have drawn a green dashed vertical line there. That particular day, the 34 EMA and SMA has moved above 200 EMA and SMA. The buying is done on next day because we require day to complete. It may happen that in between, in middle of the day, the prices may start falling and moving averages may not cross the larger moving averages at end of day. So we have to wait till end of day, and next day one should take a trade. So one should have done buying on 5th of August. If that buying was done, what is the result? 5th of August is on left hand side. From there you can see how prices moved up till November 2021. Almost 1 year, 4 months. It moved from 1672 to 5900, almost three times. So trend, once we take a position in the side of trend, we don't know how far this trend will go on. So there is one topic about exits also. I'll be taking that topic in next session, how to exit. Now we are only talking about the entry. Entries will be different from exits. The methods will be different. If we keep the methods same, then there will be no profits. So this is the first scenario when trend changes from down to up. The trend on weekly chart was down, it changed to up, and this was the methodology we used to enter the stock. There is another scenario where the trend is already up. Long back it has changed from down to up and it is running up. In between we want to buy. How to buy that? So this is the buying setup for trend continuation. On higher time frame chart, that is monthly, the price should be above 200 EMA and SMA. The price should be above 34 EMA and SMA. On medium time frame, that is weekly time frame, the price should be above 200 EMA SMA but should be below 34 EMA SMA. And on smaller time frame chart, some sort of price reversal pattern should unfold. I have given one example. There is Aurobindo Pharma. Previous to on monthly chart, left hand side, the bottom is there. Previous to this bottom, the prices were falling from up to down. And on 30th of September, first time the stock was above 34 EMA SMA as well as 200 EMA SMA. This is the first condition met. The first condition on monthly chart was price should be above 200 EMA SMA and should be above 34 EMA SMA. So it happened on September 2013. But suppose we miss that rally, miss this opportunity, and we are somewhere in say 2015 or end of 2015, around end of 2015. We don't know how far this trend will go up. And now if somebody wants to buy, then how to buy? So on weekly chart, we have to wait till the prices crosses below 34 EMA SMA. You remember I informed that the main idea is to buy in corrections. In an uptrend, to buy in correction. So on monthly chart, uptrend is there, and in weekly, the correction is happening. The correction started from 5th of February 2016. Before that, all the falls or all the downsides were just a pullbacks because they didn't cross below 34 EMA SMA. They came down to 34 EMA SMA, but again after taking support around that moving average, they moved up. On 5th of February 2016, for first time they fell below 34 EMA SMA. So correction is happening. Now we have to buy in correction. So we will move to next lower time frame chart, that is daily time frame chart. So on this screen, the weekly is on right side, now it is on left side, and here the right hand side is the daily chart. From 5th of February 2016, if you see, the market was falling, it came down, and the first blue arrow, it is a hammer. It is a hammer pattern. Hammer is a reversal pattern. So generally one buys on cross of hammer, cross of high of hammer. But here I'll add one more thing. After crossing that particular day's close should be strong. That means it should close at a close higher at upper end of the that particular day. Whereas if you see the next day after hammer, the though the day opened at higher level, but at end of day it came down. So it is not a strong close. So what we'll do, we'll put one horizontal line on that particular high, the red line. So the price whenever the price crosses above this red line, then we will buy, because the hammer's high is taken out. And if this bar fail, the next bar failed to give a strong close, but whenever its high is crossed, that will be a confirmation that prices have started moving up. Now, if you see the next bar, it was again a lower close. The second blue arrow gives you engulfing, bullish engulfing. That is also a reversal pattern. But again, the next bar has become doji. Again, it has not given strong close. So we'll not buy. We'll again put a horizontal line on its high. Whenever this particular high is crossed, we'll buy. The third blue arrow is again a hammer, but again thereafter the close is weak. It is not strong enough to buy. So we'll wait. After waiting on 2nd of March, the green line's high was crossed. And here one should have bought. If one would have bought here, this was the result. 2nd of March, 683 to 895 in 7 months, almost 31% gain. Again, how to exit, we will cover in future. We are only talking about entries. How to ride the trend, that also we'll talk about. The riding a trend, it is a bit difficult because a lot of news flow and a lot of distractions happen, and that affects our psychology also. But still there are methods to ride the trend. By using this method, I run one wealth box. Its name is Trader's Delight. I took it in September 2023. The last 6 months data is available. The pink line is the return of shares which I suggested in that wealth box, and the blue one is Nifty 50. So you must be seeing that the returns using this method, the portfolio is overperforming by almost 20%. Now the portfolio contains few stocks, 7 to 8 stocks, which are rebalanced generally in a month or 1.5 month. Which are generally rebalanced in a month or 1.5 months. And out of those 7 to 8 stocks, if this method is followed, then out of 10 stocks, 3 or 4 stocks will not perform. One needs to exit in small losses. But 3 or 4 will perform so nicely that it will give a very high returns. And another 3 or 4 stock will remain mediocre. They'll give small profits. So basically, in trend following, one has to cut losses if the stocks are not performing. Taking losses is not a in trading it is considered as a expenses, and the stocks which are performing, we have to hold it. By doing this method only, by holding the performing stocks and selling the non performing stock, this is the result which I arrived at. So it is almost 1 hour, and today we have only completed about the trend as well as entries. These are the basic entries. In next session, we'll add some more filters to it so that we may get far better entries and some methodology to write the stock. I hope everyone enjoyed this. If there are any queries, I am open to it.
As there are no questions, we'll conclude this session. So, as we conclude, let's apply this newfound understanding to make informed financial decisions. To all our attendees, thank you so much for joining us. Let's continue this journey together. Stay informed, stay inspired, and stay empowered. Keep an eye out for our next informative webinar. Until then, stay connected with us for more updates. Thank you once again for being a part of Yes FinPulse.